Wall Street is buying up your farmland. Your grocery bill will explode. The price tag tells you faster than headlines. Last summer, a head of romaine that used to be $1.49 rang up at $2.99. Eggs that were $1.60 a dozen in 2002 hit $4.82 at the 2023 peak and still hover near $3.50. Milk climbed from roughly $3.20 a gallon to about $4.50 in many stores. While you stretched recipes, deep-pocketed buyers showed up with cash offers farmers couldn't match, and the tolls on water, storage, and transport quietly rose. Tonight we follow the money, how farmland turned into a finance product, how gates replaced fences, and what actually protects your wallet. Farmland becomes a financial product. It started in pitch decks, not pastures. Farmland moved from family legacy to an allocation line. Low volatility cash yield from rent or crop share, plus appreciation tied to water and access. The logic sold itself. People eat in recessions, arable acres with reliable water are limited, and climate risk rewards reliability. Institutional capital listened. Cheap money poured the foundation. After 2008, near-zero rates dulled bonds and made equities feel jumpy. Supply chains cracked, inflation clocked back in, and farmland looked like ballast. USDA shows average cropland near $2,760 per acre in 2008, clearing $5,000 by 2022 and about $5,460 in 2023. The NCREIF Farmland Index delivered steady long-run returns since 1991, with cash yields around 4 to 5% and appreciation layered on top. For pensions and endowments with decades-long liabilities that read like a sleep-at-night line item. The buyers were patient whales, pensions, endowments, sovereign funds, family offices, arriving through specialist managers or in-house teams. They didn't need to own everything. They needed to set the marginal print where water is bankable and outlets are close. Increase-tracked properties multiplied since the financial crisis into the mid-teens billions by value. Still a sliver of America's multi-trillion-dollar farm real estate, but prices set at the edge. Safety morphed into a playbook. Assemble contiguous blocks for equipment efficiency. Swap flood for drip or high-efficiency pivots. Standardized triple-net leases so taxes, insurance, and maintenance sit with the tenant. Add on farm storage to sell past the harvest crush. Tie acres to crush plants, packers, rail, or barge. Each tweak reduced variance and created proof, telemetry, soil tests, irrigation logs, that appraisers and lenders reward. Underwriting rested on two pillars. First, yield, fixed rent or flex leases with inflation bumps or commodity bands. Second, appreciation, water reliability, proximity to outlets, crop optionality, and in some counties, non-AG development pressure. When purchase cap rates compressed in the free money era, managers leaned on operations and tenant quality to keep equity returns in the high single digits with modest leverage. Water sat at the top of every memo. In the West's prior appropriation systems, late-season surface rights and adjudicated groundwater are the true asset. In the Midwest, tiled drainage, aquifer stability, and rainfall patterns proxy for finish. Everywhere, the equation repeats. Land value equals water value, plus access. Climate volatility turned diversification into policy. Different weather regimes, planting windows, and failure modes smoothed at the portfolio level. Speed won deals. Funds showed with cash, clean contingencies, and 30, 45-day closings. Local operators, bound to operating lines and seasonal cash flow, struggled to match. Sale-leasebacks greased the shift. An owner unlocked equity to pay debt or settle an estate, stayed as tenant, and the fund booked predictable income. In good years, it felt balanced. In tight years, fixed obligations weighed on the farmer first. A feedback loop tightened. Hot auction prints lifted appraisals. Appraisals expanded operating lines and investor firepower. Rents nudged up at each renewal, sometimes indexed, sometimes market. When commodity prices cooperated, it penciled. When diesel spiked or basis sagged, tenant PNLS absorbed the blow. Diversified portfolios averaged it out. Meanwhile, the middle consolidated. Fewer processors, larger elevators, bigger cold stores, each controlling intake, specs, and timing. Handling fees, appointment windows, shrink rules. Small per unit, large in aggregate. The thesis widened from acres to valves, water allocations, storage capacity, loading rights, rail slots. Control at the gates turned congestion into basis and fees that drip into returns. Now layer the consumer lens. Grocery inflation isn't a one-to-one pass-through from land to shelf. Inputs like fertilizer and packaging swing harder. But higher baseline rents and infrastructure charges harden farm break-evens. When a shock hits, low rivers, drought, plant outages, fixed costs look for a lane. They move forward quickly, and when the shock fades, standardized contracts slow the fall. That's why your romaine doubled while eggs calmed, but didn't go back to $1.60. By the time mainstream coverage noticed, ESG slides praised soil health, fractional platforms promised access, and ownership hid behind LLCs. Public debate fixated on foreign acres, while institutional U.S. ownership stayed modest in share, but heavy in hotspots. The real shift wasn't total acres controlled. It was price setting and gatekeeping, where water is reliable and outlets are near. One more layer matters for credibility. Elite players validated the thesis. Harvard's endowment spent years assembling California farmland with attached water, betting on reliability as value. And after calling the housing crisis, Michael Burry told investors his most interesting long bet was water, owning where the flows and rights create optionality. Those moves weren't stunts. They telegraphed where finance thinks scarcity gets priced. This is the hinge. Farmland as an asset class isn't every deed changing hands. It's finance changing how land is valued, leased, watered, stored, and sold. The rent check clears before the register prints. The question is who eats the squeeze when weather and markets tighten, and how that pressure finds your cart. To see it up close, we need to open the toolbox and watch how scale gets built. The investor playbook, how they acquire at scale. Start with a map, not a listing. Funds circle counties where three things line up: bankable water, efficient soils, and fast exits to processors, crush plants, rail, or barge. They underwrite the county first: water law, historic yields, outlet capacity, then drop to the field level. The goal isn't the most acres. It's the right nodes that stitch into a platform appraisers and lenders reward. Deal flow runs on quiet phones. Institutional brokers share whisper, listings long before auctions. Regional farm managers maintain ledgers of aging owners, complex estates, and absentee landlords tired of chasing checks. When a lead ripens, investment committees are pre-wired. Cash, minimal contingencies, 30 to 45-day closes, flexible possession so a seller can harvest before handing over keys. A local operator needs time for bank approvals. The fund needs a title report and a wire. Sale-leasebacks are the silent engine. An owner unlocks equity, pays debt, settles with siblings, upgrades a combine, then signs a multi-year lease. The fund books predictable income. The farmer keeps farming ground they know. It works until margins thin. Renewals move to market, not memory. Triple net terms put taxes, insurance, and maintenance on the tenant. Add CPI bumps or commodity bans, and landlord cash flows get steadier than the growers. Aggregation is where value leaps. A single 160-acre quarter is fine. For quarters, contiguous, with matched pivots, shared access, and one storage yard become a platform. Contiguity cuts turn times, reduces headlands, and supports variable rate passes that matter at scale. Appraisals see lower operating risk. Lenders price cleaner collateral. Exit cap rates tighten. Funds overpay a hair for the parcel that unlocks contiguity because the block re-rates as one unit. Water diligence leads every memo. In prior appropriation states, senior surface rights and adjudicated groundwater set the true ceiling on yield and rent. Teams hire hydrologists, pull diversion records, map well logs, and model pumping costs. They price the option to finish in August, not just plant in April. In tiled Midwest ground, drainage maps, flood history, and outlet reliability matter as much as soil class. Land equals water plus access isn't rhetoric. It's a spreadsheet cell that drives price. Bidding discipline hides inside simple math. Target cap rate versus achievable rent under conservative yields and basis. If a block supports $275 per acre, a 5% unlevered yield implies $5,500 per acre. The fund sets a ceiling and pushes to it when strategic value, water, contiguity, outlet proximity, justifies the premium. On auction day, they're not buying nostalgia. They're buying a pro forma. Structure compartmentalizes risk. Each parcel sits in its own LLC for liability and loan sizing. Those roll into a holding entity that matches investor mandates. Some portfolios wear a REIT wrapper for tax efficiency. Others stay private with K1s and depreciation flowing to limited partners. Debt sits at the asset or pod level, often fixed or swapped, with laddered maturities and covenants meant to survive a 2-year commodity slump. Operations turn dirt into data. Managers standardize leases with clear maintenance, replant clauses, drought triggers, and flex overlays. They negotiate bulk inputs, seed, fertilizer, crop protection, at prices a single farm can't touch. They install moisture probes, telemetry on pivots, and weather stations to document reduced variance. That documentation matters. Lenders and appraisers expect dashboards alongside soil maps. Storage is a lever, not a luxury. Adding bins, dryers, and aeration lets tenants sell after. Harvest crush into better basis. In specialty crops, pre-cool and cold storage separate premium from cull. Funds co-own or contract priority slots at regional hubs. During low river seasons or labor shortages, that priority sells for real money. A few cents a bushel or dollars per ton across big volume justifies capex a single operator couldn't finance. Contracts lock exits before seed goes in. Multi-year offtakes stabilize cash flow. Basis floors or quality premiums narrow revenue swings. Some portfolios add minority stakes in elevators or transload facilities to secure throughput. It isn't monopoly, it's queue position. When storms snarl schedules, slots go to those with contracts, not best intentions. Tax tools smooth edges. Depreciation on irrigation, wells, and storage shelters income. 1031 exchanges recycle gains without immediate tax drag. Estate planning defers hits and enables long holds. The net effect: patient capital with lower friction than a sole proprietor, able to accept steadier returns and fund resilience. Community optics are managed, not ignored. Good managers hire local, sponsor FFA, and keep service calls in county. It helps when water tightens or leases get tense. But opacity remains a feature. LLCs on the deed, pensions behind the curtain. Distance protects negotiations and concentrates decisions away from the parking lot. When an asset underperforms, the playbook pivots. Shift rotations, adopt drought-tolerant hybrids, upgrade pumps, or sell non-core acres and double down on secure blocks. Portfolio math tolerates surgery. The tenant can't move a canal. This is extraction presented as efficiency. Control the nodes, water allocations, storage rooms, rail slots, and the rent check lands on time even when neighbors struggle. It isn't about owning every acre. It's about owning the pressure points every acre must pass. Yield math, where the profit really comes from. Here's where the spreadsheet turns into cash. Investors don't fall in love with soil. They fall in love with edges that repeat. Start with the base. Cap rate equals annual rent divided by purchase price. If a 1,000 acre block supports $275 per acre, that's $275,000 a year. Pay $5.5 million and you're underwriting a 5% unlevered yield, clean, boring, and brutally honest if any input shifts. Lease design shapes that base. Fixed cash rent gives certainty to the landlord and pressure to the tenant. Flex leases share risk. A lower base plus upside bands tied to local cash prices or revenue per acre. If corn clears a threshold or gross dollars per acre jump, the owner takes a kicker. Layer indexation, small CPI bumps or preset steps, and you've turned inflation into a line item. For tenants, that's survivable in thin years. For landlords, it's automatic in good ones. Appreciation is the quiet engine, and it rewards reliability. Two fields with identical soils diverge on one variable. Can you finish in August? Late season water, senior surface rights, adjudicated groundwater, earns a premium because it reduces variance. So does proximity. Being an hour closer to a crush plant or elevator with rail lowers shrink, fuel, and time, and lifts odds of catching a strong basis window. Appraisers translate reliability into value. Lenders echo it with better terms. Prices move even if county averages stall. Operations turn nickels into dollars. Bulk input buys shave seed, fertilizer, and crop protection costs for tenants inside the platform. Standard soil testing and variable rate scripts cut waste without losing yield. Moisture probes and telemetry trim irrigation passes and electricity. On-farm storage captures carry and basis improvement after harvest crush. A few cents a bushel across a million bushels funds the bins that enabled it. In specialty crops, pre-cool separates premium from cull. The price delta pays for cold rooms, then some. Now layer financing. A 5% unlevered yield with prudent debt fixed in the mid-4s to low 5s can push equity returns to high single digits. That spread is fragile. When rates rose, either cap rates widened or rents had to work harder, or equity returns shrank. Managers reacted by adding more flex exposure, squeezing operational variance down, and staggering maturities, so one refi never sinks the ship. The math forgives volatility. It punishes complacency. Risk management narrows the tails. Revenue or yield insurance cushions disaster. Hedges, selling futures, or buying puts on a slice of expected production, lock floors. Multi-year offtake stabilize basis, or pay quality premiums. None of this removes risk. It shrinks the swing enough for investment committees to underwrite tighter cap rates because catastrophic loss is less likely. Upgrades re-rate assets in ways tenants feel and owners monetize. Convert flood to drip or high-efficiency pivots, prove lower water per unit of output, and show tighter yield bands. Lenders rescore the risk, appraisals rise. The valuation lift hits the owner's balance sheet long before a sale. The tenant benefits from steadier operations, but the re-rate sticks to the deed. Meanwhile, the tenant stands closer to weather and cash calls. Fixed rent, input prepay, diesel, and repairs stack up before harvest. A consolidated elevator network adds handling fees, appointment windows, and stricter shrink. If the tenant isn't inside the platform's bulk deals and storage, they buy retail and wait in longer lines. Small line items become real money by December. Here's the transmission path to your receipt. Hardened rents lift farm break-evens. A stress opens, a low river, a diesel spike, a short crop, and elevators raise basis to pull grain. Processors lift bids to keep plants full. In oil and meal, that flows into feed, then meat and dairy. In specialty crops, stricter specs and pre-cool urgency raise gate fees. When the stress fades, standardized contracts step down slowly. The rent doesn't cut itself. So where does profit really come from? A predictable base yield from rent and flex bands. Appreciation tied to water reliability and outlet proximity. Operational savings harvested by scale. Modest leverage that turns 5% into 8 to 10% in cooperative periods. And tolls at choke points, storage, pre-cool rail slots that convert timing into money. Add insurance, hedging, and disciplined underwriting, and the portfolio behaves like a calmer bond with sun and rain. For farmers, the same stack reads as pressure. For shoppers, it reads as prices that jump quickly and drift down slowly. Romaine at $2.99 instead of $1.49. Eggs near $3.50 instead of $1.60. Milk holding around $4.50 a gallon because every toll along the way found a lane and kept part of the lift. Farmer versus fund. Two strategies, one market. Put two ledgers side by side. One is a kitchen table spreadsheet, seed, diesel, land rent, property tax, a tractor payment that can't miss. The other lives in a portfolio dashboard, leases by region, maturities laddered, risk spread across weather regimes. Same soil map, different oxygen. Time runs differently. The farmer's year is seeds out, rent due, harvest in, taxes paid. Miss a planting window, and the calendar won't bargain. The fund's year is vintages and renewals. A flat season becomes a footnote. If Indiana sags, Washington steadies the chart. Capital follows cadence. A family operator leans on an operating line size to collateral, covenants, and a banker who demands coverage. Repairs fight with tuition and a roof. Higher appraisals don't buy diesel today. The fund's debt is swapped, fixed, and staggered. Maturities are planned, not pleaded for. Risk sits in documents. Triple net leases push taxes, insurance, and maintenance to the tenant. CPI bumps or commodity bands add slow pressure. A drought trigger may shave a fraction, but the base rent persists. The landlord can replace an operator. The operator can't replace a landlord. Scale is an everyday edge. Managers buy seed traits and crop protection in bulk. They pre-book custom applicators and harvest crews. They negotiate offtake before posted bids. Tenants inside that system share the discounts. Neighbors outside pay retail and wait in longer lines at consolidated elevators that now require appointments and charge for lateness and shrink. Small line items at scale become gravity. Here's where it stops sounding abstract. After settling his mother's estate, A third-generation grower in the Plains sells 600 acres in a sale leaseback. The check cleans debt. The lease keeps him on the land. Spring runs late, diesel climbs, basis refuses to behave. He hits the new standards, variable rate scripts, moisture probes, but misses yield by a whisper. Cash tightens. The fund reports steady rent, variance down, portfolio on plan. Same field, two realities. Crop choice splits strategy. A family operator mixes corn, soy, maybe a vegetable block to stagger labor and risk. The fund leans toward uniform rotations that match processor schedules and offtake contracts. Standardization simplifies logistics and turns timing into money, until pests or prices target that uniformity. A portfolio tolerates concentration. A single farm can't. Water decides outcomes. The fund paid up for a finish in August, senior surface rights or adjudicated groundwater, and wrote leases that expect finish, not effort. The tenant delivers or renegotiates from a weaker seat. The neighbor with junior rights farms hope and watches a hot wind erase kernel depth. One makes grade, one sells disappointment. Negotiations are asymmetric by design. Renewal isn't just dollars, it's duties, replant clauses, disease protocols, possession timing, drought triggers. Savvy tenants push for flex bands tied to local cash prices or revenue per acre, so a bad year doesn't end the relationship. Savvy landlords insist on indexation and clean maintenance. Each clause decides who eats which shock. In tight years, commas matter. Banks read pain differently. A family breach of covenant triggers tighter lines, forced hedges deferred. Upgrades. A fund lender looks at the sponsor, the reserves, the other states checks still clearing. One hailstorm rewrites a family's next 3 years. A fund calls it dispersion. Labor feels the consolidation first. Crews fold into larger outfits with HR and schedules. Some jobs gain benefits. Others get more seasonal and specialized. The independent trucker who dumped at 3 small elevators now idles for an hour at one regional hub, paying the invisible tax of a long line and a strict appointment clock. The farmer eats overtime. The fund counts throughput. Community costs don't show up in cap rates. Repairs drift to regional vendors. Profits wire to pension beneficiaries. The Little League banner swaps a family name for a brand. The diner waits another month on a hood replacement because the contractor is busy installing cold storage for a portfolio across the county. Frictions, not scandals, wearing a place thin. Here's the villain moment, clean and simple.